Recording is on, which is great. I'll go to the lobby and I'll start admitting people. So, any questions before we start, Ros?
Just anything, if you think I should know anything, any banana skins I should watch out for.
I don't think so. I don't think so. We're all up. They're all lots and lots of lovely people. So let's admit them.
I know that.
There we go. Here we go. Good morning, everybody. Morning, Brian. Morning, Lorna. Morning, Peter. Morning, Bill. Morning, Tom. Morning, Sean. Morning, Charles. If you've just joined, please, if you could mute, please, that'd be great. There is a bit of background noise. Morning, Terry. Great to see you. And morning, Lisa. Thank you. If you could mute, please, that'd be great. Thank you for that. Great, great, great. Brilliant. Excellent. Thank you. And morning, JQ. Morning, Terry. Morning, Barry. Excellent. Excellent. And as I say, if you've just joined, Charles, both Charleses, if you could both mute, please, that'd be great. Just to cut out any background noise, that'd be great. So you can't hear. Okay. Well, Chris, maybe go out and come back in again. It may be your end. So yeah. Anyway, there we go. Morning, everybody. Welcome to this week's coffee morning pension playpen. We're delighted to have Baroness Ros Altmann on the call today, and I think she's got a lot to say about investing in Britain and a few other things. Maybe if we get round to that. I'm going to monitor the lobby. I'm going to monitor the chat room. I think Henry's going to be the sort of conduit between you and Ros. So I think that's good that Henry can keep an eye out on what's going on. And as usual, we are being recorded. So thumbs up, Sean, Tom, everybody, thumbs up. We're being recorded. And without any further ado, I'll pass you over to Henry. If you want to make a point, then please put a point or a question in the chat. But as you know, we prefer interaction, so raise a hand and you can ask the Baroness anything you like within reason. So there we are. Henry, over to you.
What do you want to say, Ros? I mean, you're the boss around here.
No, you're the boss, Henry, actually. But I'm happy to just maybe start with a few thoughts.
What you wrote to us as a letter, which I put on my blog, I think it's a wonderful way into what we're talking about today. I know there are people with violently different views.
I would love to hear.
They've actually spoken here. But,
I would love to hear what everyone else thinks and why this proposal that seems to me a no-brainer is causing controversy and such resistance within the pension industry. Because the way I see it, and come back at me please, pensions can be the key to reviving Britain's fortunes. The government wants to boost growth. We need long-term investment. We've got the lowest investment rate of all the developed countries. That didn't used to be the case, but it is now. And I think pension funds have been in many ways responsible for the loss of investment here, because we've lost our domestic institutional asset base that used to automatically support UK companies. But more importantly than that, for years, the pension fund industry and government have had this relationship where there is the payment into pension funds, in other words, rewarding pension fund asset managers, of billions of pounds of taxpayer money designed to boost long-term investment and obviously help people have better pensions in the long run or a more comfortable retirement. The scale of the gross tax release is now estimated to be over £70 billion a year. Put that in context. The defence budget is 52 billion. The policing budget is 18 billion. The scale of this 70 billion is just so enormous. And you have to ask, is this value for taxpayers' money?
But I think that 70 billion doesn't count the amount of money that they get back from pensions and payment, does it?
That's irrelevant to the argument, which is that this money is being paid now. Anything that is recovered is money that was recovered from previous tax reliefs given in the past, and any investment returns that were earned along the way tax-free. So I'm looking at the gross figure, the money that would be not spent potentially now if there were no reliefs, tax and NI, say, on pension funds. So my proposal is simply that because pension funds seem to have a problem with believing in Britain and supporting British companies, and have decided that the returns over the long term will be much better by not investing much in the UK, we need to change their risk reward calculations somehow. And therefore, if, let's say, 25% of all new contributions must be put into UK growth assets, which could include real assets, social housing, housing infrastructure, but also listed equities, because our listed financial markets are dying. We all know that. And this is a direct way of changing the equation. Using money that's already being spent at no extra cost to the exchequer, you would bring back the regular flow of domestic money into corporate UK, the British economy, and helping long-term growth. And I have to say that if you asked most people how they would like that 70 billion spent, I don't think they would tell you that what they would prefer is to use it to help other countries and not ours. But we don't ask them, and most of them don't really know what's going on, to be honest. And if trustees are saying, and pension fund managers are saying, don't tell us what to do with this money, ignoring the fact that so much of it actually originates from the taxpayer and from the Treasury, which may not continue to be paid, for example. You know, this isn't fixed in stone. The government could easily say, we've got 70 billion here, let's invest it ourselves if they're not going to do it. But I hope that doesn't happen. So the equation would be, if you want to invest more than 75%, say, that's a figure I've just used because I think you can justify that quite easily on several metrics. If you want to put more than 75% overseas, go ahead, but you won't get the taxpayer subsidy added to the contributions from your members and employers. It's not mandation in my view at all. It's actually proper incentivization. We're incentivizing people to invest for the long term with all this money anyway. That's the aim of tax relief, to build up long-term investments here. Well, sorry, for people to have better pensions later. But if pension funds have stopped believing in Britain, stopped supporting British companies and markets, then how else are we going to find the money that we need, and we all must know that we need it, to revive Britain? Our financial standing and our financial markets are crumbling. I know that it sounds dramatic, and of course, we've got plenty of companies left. But if you look at the takeover bids that have happened, if you look at the lack of IPOs, if you look at the great companies either being snapped up, and I think on the cheap, by overseas buyers, taken private, or deciding to list elsewhere.
Lansdowne, yeah.
Sorry?
Walls ice cream. I'm thinking of free. Walls ice
Yes.
cream. I'm thinking about Hargreaves Lansdowne, just gone to PE. Yeah, and Wise, which has just gone to America, which was our star entrepreneurial.
But, you know, we've got other great smaller companies too that have just either been taken private or are going elsewhere because Britain no longer has an automatic source of support for growing businesses. It used to. When I started managing pension fund money in the 1980s, late 70s, 80s.
County NatWest, was it?
I was started at the Pru, actually. And then I went to Rothschilds and finally NatWest. Sorry, Chase was in between. But, you know, it was axiomatic that you were looking for good companies to invest in for the long term. Here, the theory of any capitalist economy is you want to be in equities, not bonds. And we used to laugh at European pension funds who had almost all their money in bonds, while we were getting much better returns in the long run, obviously with the volatility, and that has caused a problem with using so many equities rather than relying on fixed income, which of course increases the costs of providing any pension fund because you have lower expected returns. You've got lower risk, but that is associated, unless capitalism doesn't work anymore, which I'm not a believer in, others may be, it doesn't make sense to me that our pension funds have shunned equities so significantly. But even within the equity portions that they have now allocated, so little is dedicated to the UK. And we are the outliers by a significant margin in global terms. You know,
got a bit of feedback.
I don't know where that feedback's coming from.
So I think it's Chris Giles, but I've muted.
Oh, fine, okay.
We have a really interesting case study in Scottish widows who've said they're going to revert to the kind of distribution that you get from basically the market weightings. What would your message be to Scottish widows and beyond them to the Lloyds Bank?
My message would be, go ahead, do what you like, but don't expect taxpayers to pay for it. Why should taxpayers give you the money not to invest in the UK when what we're looking for is higher long-term investment in the UK? We don't have the fiscal firepower to spend all this money on boosting British growth. And actually, I believe in Britain, we have got some amazingly strong companies, promising companies. We've watched for years now, 2-3 decades maybe, but it's accelerated recently. These wonderful startups and scale-ups not be able to find money here because there isn't a natural domestic buying source anymore, and therefore be snapped up and go overseas. We lose that growth in our economy, potentially. We lose tax revenue from those companies. It just seems that we have created this doom loop for British markets, risk assets, and underneath it all is the weight of pension fund money that has been constantly selling the UK on the grounds that it has always underperformed in the past, you know, always being the last 5 to 10 years, maybe. But that is a self-fulfilling prophecy, because if pension funds, who are the biggest source of institutional capital, and insurers, you know, there is a connection here. If they started to be looking to invest in the UK instead of just going, well, passive management, global, UK is a small portion, therefore that's what we're going to do, it's low cost. And this drive to low cost pensions has gone way too far in my book. It just automatically leads you to say, give up on trying to find the best companies and just go passive. You can't be criticised too much, and you've cut costs, but you've probably cut long-term expected returns for many people. Obviously not all, because not everyone is successful in the investment world, but that's the idea of investment risk, and that's what it's all about in the end.
Yeah, and I suppose that if you're going passive, you would regard that as low risk because you're not actually putting your head above the trench. You can't have it blown off. It's just by not actually making any radical decisions, using conviction, you're strangling, if you like, the market which you want to see grow, Ros.
Which we all have an interest in, unless we're not planning to live here in retirement.
Okay,
we've all got an interest in having a better country to live in when we're older as well. There are lots of elements to the thinking that is going behind all this for me. And having watched the damage being done by pension fund selling, for understandable reasons, I'm not saying that is not understandable, although I was railing against it in the early days when there was this big, move from equities to bonds. Equities are high risk. You've got to match your liabilities. But I lost that argument, and the actuarial thinking that used to drive all of us to say we want to be more in equities rather than bonds to get higher long-term returns, the Roscoe type analysis, turned on its head, and it was don't have too much in equities, have most of it in bonds to match your liabilities. Bonds don't actually match pension liabilities properly anyway, but leaving that aside, you are automatically in a period of higher cost pensions and lower expected long-term returns, the side effect of which has been to damage British growth, British financial markets, and sweep away the underlying domestic support that was there and is in other countries, France, Australia, Japan. Look around the world, the pension funds are investing 25 to 50% of their assets in the domestic market. So again, even if you want to be passive and you don't want to select companies, but I think that's a cop-out for a long-term investment fund like a pension fund. But if you do, if you haven't got the resource to do anything else, you could still have 75% in a global index and 25% in the UK and be supporting the UK, because our markets have become so undervalued relative to other countries around the world. Other countries' pension funds are looking at ours and either saying, why is it so cheap? Or saying, well, if the UK pension funds don't believe in their markets, why on earth would we be putting our money there? You can change that and start it unraveling the doom loop, becoming more of a virtuous circle, if you start restoring trading volume, liquidity, and investment interest and demand to our markets. And pension funds, for me, are a key. And I don't understand why the pensions industry is so against this idea. But if you were then to say, well, you don't get the tax relief unless you put at least 25% in the markets, that radically changes the equation anyway.
I think what we have here is not so much pension funds as investment funds offering platforms for funds to sit on and not actually taking decisions. And that's the way that the market's been for the last 15 or 20 years. But it's a different market that the pension schemes bill has in mind. One of the things it has in mind, as you rightly say, is that if people do not start taking decisions which provide some kind of bias towards certain types of assets, certain types of geographies, certain types of style, then they could well apply some form of
mandation.
mandation, yeah.
But this isn't mandation in my view.
Well,
I'd be interested to hear from other people if they think it is, but I just think it's incentivization, and it's up to
right.
you
Henry,
whether
can
you want that extra money.
We've got 2 or 3 hands raised, Ros. So let's start.
Yes,
Terry, you've had
please.
your hands raised for, and Ros can have a breather. Terry, what would you like to say?
Well, I just wonder if Ross feels if there's any correlation between the fact when you're saying about people who lost faith in Britain or putting stuff back in Britain. I think obviously most of our utilities, most of our big companies in the UK now are owned by people from abroad, and the government themselves have just sanctioned the sale of Royal Mail totally.
Yeah.
So the guy that's bought Royal
Terrible.
Mail has bought all the shares up. He owns it in totality. So to make an appeal based on the fact that, you know, believe in Britain, you're in Britain, etc., etc., you're doing that where lots of those companies have been bought, whether it's our water, you know, whether it's our gas, whatever, have been bought and are pumping money back into the very countries you're saying are doing better than we are. So the self-fulfilling prophecy, it seems to me, has been selling off all our utilities and allowing our British companies to be bought. And the last one has probably just gone, the Royal Mail one. Then, you know, how does that convince people that the government's serious about what they're saying, or we're really genuinely reinvesting in Britain, trying to get British industry going, when we've allowed most of those industries, whether it's steel, whether it's whatever it is, shipbuilding, the country has allowed all that to go abroad because it's cheaper, and then we make this sort of appeal. And then you've got the issue of tax evasion by these companies that are not British companies, etc. You know, there's millions, probably billions of pounds to be chased there. So, you know, I think it's a great idea if pension schemes, because I think it's as low as 2% now, is it, in this country?
Yeah. Well, it depends on which type of scheme you look, but across all types of pension scheme, there has been a dramatic reduction in UK equity exposure specifically.
Yeah, I saw a stat a few weeks ago, which was probably, you know, wide-ranging stat, but it was basically saying it used to be something like 60% pension schemes invested in British companies, etc., and it's down to 2%.
That's for DB schemes, certainly. There are many, and the parliamentary pension schemes even lower than that, which really upsets me.
Also got, as I understand, you've also got the, you know, a huge proportion of money that's just going straight into insurance companies if you're looking at DC schemes. You know what I mean? So is it in the round here? Are all those issues that are lined up that are taking money out of this country or money just into individual companies, is all of that going to be looked at? Because of course we need that money to invest in Britain, because we've sold everything in Britain off.
Well, we've still got plenty of big private companies who could be doing great job providing growth here. And we've got these smaller companies, the companies of the future, that are either being snapped up on the cheap, taken over by foreign bidders, or just deciding not to list here. And whether it's big companies or small companies, if you had a natural source of domestic buying like we used to have, I mean, I was always looking for interesting companies. Where's the growth going to come from? We've lost that, and yet the amounts of money we've got in the system are huge. And every year with auto enrollment, you're getting more and more money coming in via the workplace with all this extra taxpayer money on top. And it's just not helping Britain. And if the pension funds can't see the risks that entails from government policy, at some point saying, why on earth are we spending this money? Then I'm not quite sure how to get the message across, but it seems to me it's in everyone's interests to say, yes, we need to make sure pension funds boost Britain and get on with it, because the Mansion House Accord is focused mostly on private unlisted securities and small businesses only. Whereas we need help across the board. We need pension funds to be investing across the board in our markets to re-rate them. We've become globally derated. We used to sell at higher ratings than Europe. We're now lower. We used to be similar to the US, although slightly cheaper. We're now way, way cheaper. Our companies are just as good, if not better, in many cases, as those that are selling more cheaply elsewhere, and we're losing them. And it damages long-run growth.
There's a huge amount of chat, and we can't go through all of that, but I think we ought to keep up with the questions. And one's coming from Charles Malcolm Brown, who I know has had dealings with Ros recently, because I looked at his site this morning and discovered a lovely message from her. Do you want to ask your question, Charles?
I do, but I'd like to preface it by saying thank you so very much indeed, Ros, for your comment. Absolutely agree with you.
Thank you.
And I'm a big fan, but and I love the idea of pumping money into the UK economy, the infrastructure, and so on. And I completely take on Terry's and I'm sure other people's views that an awful lot of this goes out of the country. My question is, I mean, from a sort of, I mean, you've kind of outlined the stick side of the risk calculation. I can't see any carrots. I'm wondering because, hold on. I'm just wondering because, there is the mythological Magnificent Seven in the States now, plus some service sector operations over there, which have got a pretty healthy yield. I can't see any differentiation between generally investing in UK equities, listed or not listed, and protections, both against the money disappearing off abroad, or for that matter into dividends. There's been no, and I get the talent spotting issue, but there isn't a sort of elite group of UK companies identified, as far as I'm aware, that would be a sort of UK version of the Magnificent Seven plus X, wherein the funds weren't going to go abroad. Now, I mean, if that kind of a group of companies, and you rightly talk about plenty of large companies in the UK still based here and operating here and what have we, and also a number of smaller companies, and completely fair comments. But if I could, thinking about it from the scheme investment point of view, if I could differentiate between a UK Magnificent Seven or nine or however many, and the generality, and exclude those companies where the funds are just disappearing abroad, that could be an attractive investment opportunity, and thereby create more of a carrot relative to less of the stick, if I might say.
What do you think, Ros?
So, to me, the carrot is the stick. What you call the stick, I call the carrot, which is the tax relief.
Yeah.
If you want that money from taxpayers, we will subsidize your investment fund. If you don't want the money from taxpayers, then you can do what you like. I personally would do the same with ISAs, actually. I don't understand why taxpayers should subsidize people to invest all the money elsewhere. There has to be some quid pro quo, surely, some value for the taxpayer money. As regards, the Magnificent Seven, the Americans love doing all this kind of thing. We had the Nifty 50 in the olden days. We got the Magnificent Seven now. But the point of pension investment for me, especially in the equity markets, is you want to hold a range of different companies. I think there is potential, for example, Henry and I have talked about this many times, the UK investment trust sector. It specializes in real assets in alternative energy, for example, or headlines today about REITs that are investing in GP surgeries and managing and running for the NHS GP surgeries. These companies shouldn't be selling at discounts or, selling on the cheap or being taken over by private equity. But if there aren't the domestic buyers looking for them and needing to back them to get the incentives, then we won't rebuild the strong investor base that we used to have here, that was just always looking for the good growth companies or the companies that could deliver strong, reliable yields and upside in terms of capital to their investors. Investment trusts, in my view, could join together, perhaps, a bunch of different sectors of investment trusts, whether it's in wind power or solar power, or, there's lots of them that have each done really well, but they are languishing at low ratings, partly because of regulatory ridiculous cost disclosure rules that suggest to investors they are paying the company to own the shares, which is just a nonsense, just as if it was an open-ended fund, which it's not. And therefore, if you want to report low-cost portfolios, you don't want to hold those companies, even though you know they're undervalued. So we need to change that equation. And there are ways in which you could package up some of the companies that we have. But why would any investment bank even consider doing that if there isn't a ready domestic investor base looking for it?
I'm going to have to move the conversation on, good as the answer was, because we got other people who were wanting to ask. And we got the rarest of things on Pension Playpen, a woman asking a question of a woman. So Rosalind, over to you.
Rosalind of Rosalind.
Yes. And
Rosalind.
it's great, isn't it? It's great. Hi, nice to see you. So
Andrew.
yes, it's nice to see the Rosalinds are taking over again. Just had 2 points really. The first is this is going back a long time, but when I first started looking at pensions internationally, I remember being very surprised, particularly when I was doing my PMI international stuff for those exams years and years ago, that many countries had regulations that said you had to invest a certain proportion in the home country. So sort of the first part of my thought is, when we look at us compared to other people, that must be part of what's going on. And have we sort of missed the boat? Are we a bit too late? It's my first question. My second point is, you've made the point, and I absolutely agree, that there's been a really shocking level of taking private and no IPOs happening in the UK. Certainly, I find myself constantly advising on take privates and haven't advised on an IPO for years. But I'm also advising in relation to the UK end of IPOs of international companies that are listed elsewhere. I think the flight from listed markets to private equity and the investment of the funds that our pensions and all our other investments are in private equity has been a massive change of the last 10, 15 years. And I suppose part of what I'm saying is, it's your vision to incentivize people to invest in listed companies, or would you be equally comfortable with funds invested in UK businesses via PE? So those are my 2 points.
Sure. Thank you, Rosalind. And I know what great work you're doing, but just to go to your questions. First of all, I don't believe it's ever too late. And actually, I think because we have this ongoing flow of investment money, and because the government is still offering tax relief, the sooner we can make the better use of it, the better, obviously. You can't go backwards, you can only go forwards. So although you wouldn't maybe want to start from here, we have no choice. But at the end of the day, the companies, in my view, and the markets have become so derated, and confidence has become so low, that this could be a kind of silver bullet that would suddenly start making people look more carefully and seriously at the great companies and investment opportunities that we still have here, our research, our life sciences, our technology. They're all world class, but rated as developing world class. So the more that these things go overseas, the worse our long-term growth outlook inevitably will be. But the sooner we start harnessing the power of pension funds, and I stress, this is at no extra cost to the Treasury, who need to do it, and want to increase long-term investment, the sooner we can start rebuilding that confidence, boosting ratings on our financial markets, bringing back investor interest, both here and overseas, and not investors who just want to snap up on the cheap, but investors who want to back Britain for the long run, which I would like to see. As far as private equity is concerned, I think there is clearly a role, but I would want not to focus exclusively on private equity because of the potential risks and the fact that we've got so many big listed companies that are offering such great value anyway.
Fair enough. Fair enough. Thank you.
I'm going to have to move on to the next question because it's Peter Cameron Brown, one of our most solid citizens. So, Peter, what is your question?
Firstly, can you hear me?
Yes.
Right, okay. Yes, I'm just have a problem, and good morning, everybody. I have a problem with the situation. The tax relief is given to the company or the individual paying the contributions. The individual, in terms of either DB or DC, doesn't have any control over the product in which these pension contributions are paid into. It's the employer that chooses the pension arrangements. The investment of those contributions is then done by an independent party, a third-party trustee, in the case of Master Trust, or even by the individual himself in a contract arrangement, whether he chooses to go into a default fund or chooses his own investment profile. I think that the problem arises that you really should be addressing the employer's contributions because they have the greatest influence in choice of that. And if they see their contributions being penalised by lack of tax relief on them, they are going to seek to minimise them always so that they don't end up paying twice, if you like, for the same benefit. So they will not seek to change the investment profile of the pension arrangements, but they will actually seek to minimise the amount of pension provision they give. Or alternatively, I would suggest they should reopen their DB schemes to allow them to control the reinvestment of that money through the consultation process that exists in DB scheme, and also then get the benefit of the investment return from the balance of cost arrangement. If they get good, then they can reduce their contributions, pension holidays, whatever. So I have this great fundamental concern about who you're addressing with the proposal. So my comment.
Thank you, Peter. I mean, obviously that's a really, really important question. But the way I see it, the employer is in control of who will be managing the money for their auto-enrolment scheme. So if their manager says, well, we think you're going to do much better, or your members are going to do much better by investing more than 75% outside the UK, the employer can say, well, I'm sorry, but I would like the tax relief, thank you very much. We'll find a new manager. I mean, the market itself is likely to correct that, in addition to which it would seem very odd to me if pension fund managers of ordinary workers' pension funds would also deny the tax relief available to their workforce. I have to leave aside for the moment the net pay schemes and assume that that issue is going to be resolved, but please don't forget about it. So, Peter, I know you would potentially say, well, isn't that forcing them to do it? But I would say, no, it's not. It's incentivizing them to do something with money that taxpayers already spend, but delivering better value for the taxpayer. You're not talking 100%. You know, if you look at venture capital trusts, if you look at AIM stocks, if you look at EISs, you have to invest in the UK. Nobody bats an eyelid about that sort of thing. Whereas when it comes to pensions, we're spending far, far more, and all the money can just go off and boost everyone else and not us.
I think the eventual outcome perhaps is then questionable, and the taxable income generated in retirement. The other risk I have is that effectively, if you start encouraging investment in a particular asset class, you just push up the prices, and you end up buying assets at an inflated price for the future. If everybody's doing the same thing.
We've had the opposite, and you know, we've had artificially lowered prices. We've had bond markets that have been artificially distorted by central banks, which have had a knock-on effect on the equity markets as well because of the impact on deficits. So you're right. The aim would be to do a kind of QE in a way, in a smaller scale, using pension fund money to unwind the doom loop, which is also being aggravated by QT now on the other side for the gilt market.
I'm going to move on now to Tom McClellan, because I know you've wanted to say something for some time. I'm sorry to those stuck in the queue, but we will get to you all.
Hi, Tom.
Hi, Ros. Thank you, Henry. So I've got a couple of comments I'd like to make, and then a suggestion. So just kind of zooming back out for a moment, I think, I mean, I don't disagree with your analysis, Ros, but I think the scale of the problem dwarfs the pension industry's capacity to solve it simply by directing. So I think it's wildly optimistic to think that if we just get the pension schemes to direct a bit of capital into the UK economy, suddenly everything will turn around. And I look across, at the current government's energy policy, the amount we spend on welfare, the low productivity, the black hole that is the NHS, our failure to control immigration, on so many aspects of the way that the UK functions. These problems dwarf the pensions industry's capacity to fix it. And at a personal level, I look at the current government. I wouldn't trust them to run a bouncy castle, right? So the idea that we could just use the pension fund money to suddenly magically turn this super tanker around, I think is for the birds. So there's that. And then specifically on pension funds, I think you're right about the question of the tax relief, but I look at the country's ongoing budget deficits for the last 25 years. We are living beyond our means. We're also not creating any kind of proposition that is appealing to younger generations. Look at the birth rate collapsing, their inability to own houses, all those things. I would get rid of tax relief entirely, Ros. I would say to employers,
that may be what will happen as a result of not doing this.
You must put at least 10% of salary into a pension scheme on behalf of your members. No more tax relief, flip to something that looks more like ISAs, save the Treasury tens of billions of pounds, allow them to reverse the ridiculous jobs tax on NI. I mean, NI is far too high. We have a massively over-regulated society. And as a final point on pensions specifically, over the last 10 years, the pensions regulator and the FCA have between 50 and 100% increased their budget and their headcount, right?
Totally agree with you on all that.
And this is just the UK pensions sector. Across the whole of society, we are laughably over-regulated now.
Totally agree.
At the same time, we've been putting more and more resources into regulating pensions. The number of pension schemes they regulate has gone down by 50%. What is going on here?
And they're trying to cut it further with consolidation.
So I would say to Torsten, you've got much bigger problems to fix than just coming to the pensions industry. So as a trustee, I'm pretty new to the world of trusteeship, but I'm looking at this and thinking, my fiduciary duty hat on, there is no way I would take my members' money and pour it into the UK economy right now. What I care about is optimizing returns for my members, and I don't see that anything the government is putting on the table would achieve that. So that.
Okay, Tom, I hear your pain and I feel your pain, but I believe in Britain and British business and British companies. Perhaps This isn't going to change things overnight. I certainly hope I didn't suggest it would, but it will reverse the direction, or it could reverse the direction, because at the moment, everybody is pointing to this potential negative outlook for the UK. If that negative outlook for the UK is partly a function of the loss of domestic long-term investment support, which it is economically, our long-term investments have been way below what they should be. Productivity has suffered. Yes, we've had horrendous political problems. We've had Brexit, whatever you think about it. It's been a disruption. We've had COVID. We've had all kinds of things. But there are plenty of other countries that have also got problems. Everywhere you look, you've got fiscal deficits. And honestly, when you look around the world at small businesses, research, life sciences, the kind of stuff that we have been so good at, innovation, we are still a world leader. But if we don't have domestic money that backs it, it will all just go away on the grounds that Britain is a hopeless basket case. And I don't believe it is. I certainly hope it isn't. If we continue on the path we're on, you're right, Tom, because I have no doubt that UK stock markets, financial markets, and the ability of companies to grow here is dying. And we need to bring
Ros,
back
let me
support.
very quickly come back on that, and I don't want to take up too much airtime, but the aspect of the pensions bill proposals that really struck a chord with me was around the British Growth Partnership, around LTAFs, around using the government's capacity to act as a broker between those startup businesses and pension funds. That makes sense to me. But a dirigiste approach of saying you must pour money into investments, whether you can find good investments or not, to me is not a recipe for good investment returns for members.
What do you call good investments? British FTSE 100 companies, some of them are absolutely world class. Why would you not want to put any money in there? We used to, we still could do. Honestly, Tom, I guess that boils down to whether you believe that our companies and our markets are undervalued, and I do. And if you don't, it's fair enough. I can't prove what I believe, but having studied all these markets for so long and looking around the world at comparable companies, the UK is being sold on the cheap for no what I consider to be real cogent reasons. There's fear, there's lack of liquidity, there's constant selling. Pension funds have kept on selling, kept on reducing. So in the face of selling like that, when all other countries have a home bias that is naturally buying their companies and at least supporting the valuations, if not increasing them, we've had the opposite with pension funds continuously, who are a huge source of money, in addition to insurers, just pulling out of our risk assets, switching overseas. And one thing I would just like to ponder with you is there a big difference between taking away tax relief from employers on pension funds and forcing them to put 10% instead of 3% or 4% into their workers' pension schemes? Either way, you're increasing employer costs.
Well, yes, on that point, but you're removing the state from the equation. You're re-establishing a link directly between the employer and the employee. It becomes an employment proposition with deferred pay built into it. And to me, that makes, at this point in time, makes more sense than taking the money off the employers, recycling it through the tax relief system, and actually in the process largely redistributing it to the wealthier cohorts of society.
Well, that's an issue about top rate tax relief, not about basic rate tax relief. But quite frankly, if I was sitting in the Treasury, I would be thinking along the following lines. Auto enrolment has been a brilliant success. We've done the objective of getting all these people putting money into pensions. At the moment, we put in 1% for all the basic rate taxpayers, who are the majority of workers we care about. If you're on higher rate tax, we probably think you can manage to support yourself in retirement without falling back on the state, say. So the employer is giving you 3 times as much as we are as a supposed incentive. We're doing 1%. Why do we need to continue doing 1%? If 3% doesn't do it, what the extra 1%? What purpose is that? So the risk is that if you start going down the mandation route, there would automatically not be any tax relief because you don't need it, because it's compulsory. But equally, we could be using the private sector rather than the state to direct investment more, which is what I would trust myself to happen. LTAFs is one option, but I don't like the idea of putting illiquid companies in open-ended funds. We saw with Woodford where that led. Closed-ended funds for me are much safer, and people can move the money in specie, sell the shares if they want to, but they'll have to take whatever the market will give them. So I get where you're coming from, and we may end up exactly where you say, Tom. I don't know. I'm sure the government is looking at that too. But my preference would be, my strong preference would be, get on the front foot. Pension funds show that you can and want to support Britain and believe that we've got great companies that are worth backing, so that we can show the value to the taxpayer. Anyway, sorry.
I've got other people to ask questions. So thanks, Tom. I think you have to just have this off-piste with Lady Wall.
Let's have a cup of tea.
Yeah, I think that's right. Now, as regards other people, John, you're next. John Matter, I noticed you've already written a blog-like question, so try and keep it short if possible, if you're there.
Well, I wrote the blog thing because I've got a guy drilling outside my office at the moment, so that's why. So hopefully stop for a moment. First of all, when I first came into the business and advised on pensions in 1972, the basic tenor was no tax, no tax taxed. That promise has been broken time and time again, and faith and belief in the pension system and politicians has gone out the window. You remove more tax relief, all that will happen is less money will go into pensions. One thing that I found difficult with the investing in Britain, SAIS and EIS and business property relief and the BES scheme originally, I've been a great fan of. I've got one at the moment, which I invested in at the start. It saves about 20% of the energy in a server farm, an important industry. We have the patents. We have the first 2 million done. We're now looking for the next 5 million. And the only inquiries we've had are from foreign rich people and 1 or 2 telecom companies who want to buy it to shut it down. Yep. Because it's cheaper for them to buy us than change their business plan. You look at investing in large companies. I commend you to read Smithers. All that's happened since the 80s is that the bonus culture has taken over. Chief executives only care about the short term and keeping their job long enough to get rich. So pumping money into some of those companies will only finish up enriching those chief execs faster. So I don't believe in it. That's why the FTSE has performed so badly. I agree with you that we're probably undervalued, and that's exaggerated by America being so overvalued. It's probably 50% overvalued at the moment. It doesn't make any sense on any metric. But to damage the people who actually are the believers in pensions by punishing them yet again, I'm facing on my pension, if there's any surplus left, of 76% on the surplus. That's obscene. So I'm going to buy a damn big annuity and gift it in my lifetime. That's what will happen. Now, this is the sense. So can we stop punishing the ones who believe in pensions and actually try and get people who don't believe in pensions either better paid and contributing or actually doing something? And then if this is, if this is such a good idea,
go hurry up.
No, and if this is such a good idea, why does Nest, with their first 450 million, partner with an Australian company to do the investing? Macquarie's are going to make a fortune out of that one. Come on. This is unreal. There are other structural problems to solve before anything tinkering with tax relief will help with. Sorry to say. So that's not my question. Tell me why I'm wrong.
So, of course, the tax interference has been a disaster in many ways for pension funds, going back to the 1990s, and well-meaning regulations and things that didn't seem that harmful happening to pensions, which actually undermined some of the rationale that employers had to support pension schemes. But we could come on to a separate piece now on DC and the IHT problems, because I think the government's sudden retrospective imposition of inheritance tax on defined contribution pensions, which are meant to be the pensions of the future, could undermine the future of DC pensions for the ordinary person. Your argument about enriching chief executives can apply to any country, anywhere. Britain has not been immune to the pay structures that are needed to attract the best people wherever they are. However, if your main listed companies are selling at undervalued ratings, the risk is clear that your companies are vulnerable and your markets are vulnerable. And if, as I believe, a large contributing factor, but obviously, as Tom was saying, there's lots of other reasons that you might think you don't particularly want to have huge sums invested in the UK, is because pension funds have kept selling. It's not just that they haven't been buying, they've actually been selling, which depresses markets. If you can reverse that, so they're looking to buy rather than looking to sell, then you do provide the underlying support that we used to see for the good companies. Of course, there are not good companies and good companies. That's the whole point of the long-term investing and not using just trackers. But there's a role for trackers and there's a role for active, potentially, depending on, you know, what you believe in and who your good managers are. But again, part of the problem which Nest had is, where are the good managers here? Because if you haven't got a domestic pool of money looking to invest in these things, you won't have domestic managers looking to create them. It's another vicious circle that we could start to break. I'm not saying it will happen overnight, but the sooner we start, the sooner I think we can get back on a better track.
Okay, final question, very quickly, Mr. William McGrath.
Hi, I couldn't agree more with your analysis, Ros. I think that was absolutely terrific. My only point to you to add in is, where is the trigger for change going to come? And the people that are not really being addressed at the moment are the members of, let's say, the DB pension schemes. If they started to revolt and ask for more, and they started to get hold of boards and say, why can't you invest in the UK? Why can't we put more into our into the pension scheme, not for today's people as well as the people who've gone before, I think there'll be a revolt. I think there is plenty of scope for just getting positive response from real members looking for maybe better pensions, a little bit extra on their pension, because so many of these schemes with surpluses now can afford it. So yeah. I'm not pessimistic. I think all the things you say can come true, and you don't need to change the world forever. You can start right here in shifting the balance between buyers and sellers.
I couldn't agree more on that basic premise, and I would like to see actually DC members become engaged, because I don't think they know that so much of their money is not here. It's helping America, it's helping France, it's helping Japan, it's helping
And if
China.
some of those surpluses were used to actually bolster DC as well as improve DB schemes that have gone in the past, you've got a real coalition of past and present employees wanting to see things change. And I think the industry is ready for it. It's just caught up in this sort of a narrow interpretation of fiduciary duty. And no, give people in government can give a little incentive to say, yes, if you do invest in the UK, perhaps you get your surpluses released cheaper. All sorts of simple things to do, which just make things better and fundamentally just shift this. I've seen over 40 years, like you, just the remorseless anti-UK culture which is built up completely unnecessarily.
I am as optimistic as you, I think, on the future of Britain potentially, but I'm also exceedingly concerned that that will not be realised without addressing this. And there are three strands. There's the DB strand. Some are still open. What are they doing? Even the ones that are closed, do they really want to buy out, or could they be investing for growth? DC, which is the growing one, and of course LGPS, local government scheme, which taxpayers underwrite, by the way. They're not part of the PPF. So that is, again, an opportunity which I think the government is spotting for a kind of national wealth fund of some kind, but I would rather leave it to professional managers and experts to package together good British investment opportunities.
Read Toby Nangle's excellent paper on which he delivered to the
Toby's really good.
So there are some really good people out there, but unfortunately we're running out of time now, and we're not going to be able to continue forever. And I'd like to wind up now by saying thank you very much indeed to Baroness Ros Altmann.
Thank you for all you're doing, Henry.
And thank you to everyone who's spoken, and to those people who haven't spoken but listened. We've still got a full house. There's been no drop-off, Ros. And that's amazing, because you came here and
they're all asleep.
Yeah.
No, we're not.
No, we're not. Okay. Can we give the Baroness a thank you? Yeah?
Well done.
Thank you, Ros.
Even if you didn't agree.
Thank you all. Let's try and rebuild Britain with pensions.
Thank you. Steve, I don't know if you've got anything to say.
Yeah, no, just thanks, Ros. That was a fantastic session. The video will be up on the Playpen site this afternoon. Thank you, everybody, for your input and for attending today. Hope you enjoyed it. We might need a Baroness Altmann part 2, I think, maybe after the summer recess. So lots to talk about, but I think you need a rest after that, Ros. So
but thank you, everyone, for your questions as well. It was really interesting to get perspectives.
Really good.
It takes a lot more than this to tire out Ros Altmann. I'll say that.
Oh, does it? Okay.
Right.
Moving on. Okay. Enjoy the rest of your day. Let's pray for peace in the East and hope the ceasefire holds. And let's have a good week, and we'll see you all next time. And hopefully next Tuesday we'll have another speaker on, which you'll enjoy. But Ros, thank you very much indeed for your fantastic contribution. Thanks very much.
Wish you well, Henry.
Cheers, everyone. Yeah, cheers, Henry.
Right.
Take care.
Bye.
Bye.